Okay, in this video we're going to be looking at the third type of market failure, which is asymmetric information. So we've done public goods, externalities, and now asymmetric information. Just before we get onto that, just one important question. This one says, define the term subsidy and describe the economic rationale for providing subsidies to one Australian business or industry. In your answer, refer to at least one type of market failure. So getting 1 mark for defining the subsidy and 3 marks for an accurate description of the economic rationale for subsidies. So a subsidy is defined as financial assistance provided by governments in order to support some form of economic activity. It is usually provided in the form of cash support per unit of production, and it can also include things like interest-free loans to assist businesses or tax concessions where they reduce their expenditures. So it's important to define a subsidy accurately, and subsidies are usually given to promote the production of goods and services that would be under-allocated without some form of government intervention. So in other words, subsidies are typically designed to address the market failures associated with public goods or goods with positive externalities, where in the absence of government intervention, there would be an under-allocation of resources to the production of these goods and services. So make it clear that the purpose of subsidies is to prevent an under-allocation of resources. The subsidy will incentivise producers to produce greater quantities and invest more over time, which helps to address the market failure. As prices will be lower than otherwise, consumers will increase demand and production volumes will increase towards the socially optimal level. So, that's just talking about how subsidies can work to help reduce positive externalities or reduce the under-allocation of positive externalities. In this video, we're going to be looking at asymmetric information. So, if a market is perfectly competitive, then economic agents are assumed to be fully informed, rational, and make decisions based on full information. So they have full information on prices, quantities, conditions, technologies. So perfect information can include full benefits of the products, the price of the products, prices of other products in the market, how resources are used, how the product was produced, all these things to make rational decisions. But sometimes consumers don't have enough information or have all the information about products. Asymmetric information occurs when one party to a transaction has more information about the good or service than the other. So it occurs when the consumer or supplier, so it can be either producer or consumer that has less information, cannot gain full information about the products, and therefore it leads to an inefficient allocation of resources. Two things that related to asymmetric information: products can have, there can be a thing called hidden action, where one person in a transaction acts in a way that the other person can't observe. That's often common in employment contracts, where people behave in a way that the employer can't see. And hidden characteristics, where one side of the market knows more about the product and the characteristics of the product than the others. So that might be that a car doesn't have an engine, or there's something wrong or defective about a car, or that you're sick and you're not telling your health insurance provider. So asymmetric information, adverse selection can occur with asymmetric information when the buyer knows more than the seller. So that can include with health insurance, car insurance in the workplace, and we'll talk about what that means later on. It can have problems with suppliers charging too low a price for some consumers because others are skeptical. Again, we'll look at examples with the car insurance and explain more about this slide as we go along. So asymmetric information leads consumers to adjust their behaviour to one that is less efficient or favourable for society. So some examples of where asymmetric information leads to people adjusting their behaviour. So for example, owners of good cars may decide to keep them even though it's in the best interest for them to sell them to other people. Healthy people may get charged too much for health insurance, so they don't purchase health insurance, which is an example of them not being allocatively efficient because they're not covered. Consumers wasting time when they're servicing their car. So first of all, I just want to explain what adverse selection is, then we'll look at a whole range of examples of asymmetric information. So adverse selection occurs when one party knows more about the product than the other does. So thus the informed party, as a result of that asymmetric information, purchases adversely. And therefore there's an over or under allocation of resources to certain products. So the adverse selection may be purchasing a second-hand car, which isn't up to scratch, and therefore that means you're not maximising your living standards because you've now got a car without an engine or something like that. It can mean purchasing adversely in the case that people don't get car insurance or health insurance because premiums are too high. There's a whole range of examples. Purchasing jewellery thinking that it's 10-carat gold when it's not. And it's to do with having a lack of information about products. So adverse selection when we purchase in a way that does not maximise our benefits and leads to an under or over allocation of resources to certain products. We'll look at some examples of asymmetric information in the next video.